Good morning, everyone. Welcome to the third episode of the quarantine broadcast. I can't believe it's been going on this long, actually. Today, we've got a great guest on the show, a good buddy of mine, known for quite a while, actually now, Toronto real estate agent, Justin Bregman. Thanks for taking the time today. Really just want to get right into it. We're going to be talking a lot of things real estate, go over what's going on in Toronto market. But before we get into that, for everyone that really doesn't know you, maybe tell them a little bit about yourself, your story, how you got to being, now one of the top agents at your firm.
Yeah, no, and Grant, I really appreciate coming on here. Thanks so much for having me, and looking forward to discussing some things here. So for me, got my license in 2014. So I've been doing this for quite a while now. I was actually in fourth year of undergrad, where I was taking all the courses and getting my real estate license while finishing off undergrad. I always wanted to do this. Basically, I started out just doing rentals at the very beginning. My first year, I did about 75 rentals. A lot of agents don't even take on rentals because they're quite a bit of work. They're not so rewarding, but I didn't look at anything ever as the small picture of the little bit of, maybe you can call it gas money that it pays for, or whatever you want to call it at the beginning. I looked at the future of it, whereas if you do a great job, obviously helping a renter, they're going to call you and buy with you one day. And actually, I could say almost 50% of those people that I rented in the first year have now already purchased. Some are still renting, but that's obviously where it becomes quite rewarding. I was actually at Royal LePage at the time. About 3 years ago, I was recruited to PSR, Private Service Realty, where I work right now. It's a luxury boutique brokerage here in Toronto, where we have 3 offices. And the main reason why I made the switch is because not only do I have access to do everything I was doing at Royal LePage, and I could do at any other brokerage, but we also have an enormous amount of off-market exclusive listings and opportunities that allow buyers to have less competition and bidding wars, which is something that they could really benefit from in a market like right now. And we have an enormous platform of marketing when it comes to selling your property, where we use so many different avenues through social media, obviously MLS. We're also the first brokerage that has made a partnership with Zillow in the US. So every listing always goes on the entire US market. People do want it to go on July as well. So we go to the Asian market as well. So really, when you get maximum exposure when it comes to listings in our office. And fortunately now I've become I'm in the top 1% of realtors here on TREB in the GTA, the Toronto Real Estate Board. And I've started to build a little bit of a team where I have full-time assistant and a few agents that work under me at our firm.
Man, it's appreciate sharing that for everyone that's watching. And it's just been great to see your kind of rise in the industry. I mean, we're a similar age, went to the same school. It's just kind of cool to see someone else in a totally different industry kind of rise through the ranks as well. So from a fan and buddy perspective, it's been really cool to see, to be honest. I've been telling a lot of my buddies about you, just all the cool stuff you're doing, a lot of social media, and basically, the real estate agent of 2020, right? You're using a lot of new techniques that a lot of the older guys aren't. And it's just super cool to see, right? So, for me, I'm getting to the age now where, like, even my younger brothers, both of them just bought homes in the last couple of years. Shiraz mentioned already, he's got a couple under his belt. I personally don't. But like, we're always talking to investors, as wealth managers, whether it's my friends, my buddies, our clients. Some of them have not bought real estate, and they're kind of like myself, right? And I'm curious, like, from both of you guys, and just have a kind of a free-flowing conversation, but some of those, like, rookie mistakes, right? Like, I can only imagine, I haven't went through it, but as an investor, I know the psychology and the emotional roller coaster that goes through making an investment, right? And from living through that journey with my brothers, because they just bought in the last year, it is clearly an emotional journey, right? Like, you see it, you want it, you got to have it. Like, is that a mistake that investors make? Is like, would you say that, like, a rookie real estate investor, what kind of mistakes do they make, or do you see?
I mean, if you're purely an investor, it's different, obviously, than an end user, right? And I get this conversation with people every day. They want to buy a place to live in, but they also want it to be the best investment. It's okay. I'll tell you right now. I mean, as somebody that now owns 4 properties, myself in the city, one that I currently live in, and 3 others that I've invested in. The one I live in is not my best investment of the 4, but it was the one that made the most sense for me because it was the layout that I thought was the most suitable to my lifestyle, the location, the building, everything sort of checked my boxes. But it's not out of my 4 my best investment, right? It's really hard. You know, an investor simply cares about the numbers. How much is it going to cost them to put down? What's the carrying cost going to be monthly? What's it going to rent for? Are we cash flow positive? And what's the exit value in 2, 3, 5, 10 years, however long you plan to hold it for, right? It's so, you know, an investor, let's say you want to live in Toronto, but if the best investment was in Scarborough, you would buy it in Scarborough. You may not want to necessarily live in Scarborough or wherever the case is, but as an investor, that's the most important thing, right? So the biggest thing where I've seen rookie mistakes as investors is really on product knowledge and who they're really getting the advice from. I mean, a lot of people, you know, get advice from their friends at first and don't necessarily use their agent's advice, or they don't even know how they met their agent, right? A lot of people these days are meeting their agents by clicking buttons on the internet, getting a random phone call, and before you know it, they bought a place, and it just happens so fast. And so it's really important that, you know, yes, maybe you're only putting 50 or 100,000 down, but this property is worth 500 plus thousand. It's, you know, it's over $500,000. And, you know, the margins when it comes to investing are huge. And that goes to just buying a condo and renting it out. That goes to trying to flip something if you're going to renovate it. And that goes to what I was just doing with last week, which was, you know, helping a client buy a lot to build a house and flip it, you know, and that's where you need to know, obviously, the area, the school district, how much the lot costs versus what the exit value is going to be of the finished product when you build the house, and the margins there could really make a difference on what your end result's going to be. And I've seen big mistakes and unfortunate ones where people bought just before the pandemic and had to sell at the beginning of this where there was panic. And, you know, so timing is important as well with this.
I always just go back to the emotional aspect of it, right? Because I'm always talking to the young people. Is that, you know, and whether it's my brothers or examples, but like even their friends as well, you know, it's the first time they've bought a house. It's the largest purchase they've definitely made thus far in their life, and might be moving forward. You know, we made a video actually a week or two ago talking about the psychology of investing in real estate, where, you know, it's so different from the world we work in because we see the value of our stocks and hedge funds and mutual funds every second. So Shiraz gave an example of, imagine you were driving down the street home, you know, from the grocery store, and you pulled up, and, you know, where your mailbox is, that's actually a ticker, and it just changes. And you see the value of your house go up and down every second of every day with the relationship that we have with, this is a safe investment, this is this. And don't get me wrong, real estate is safe, but I can never lose. It only goes up in value. Well, when you price your asset, which is basically what real estate is, once a month or once a year or once a lifetime, it does seem safe. But when you look at your tickers and your stocks and they change every second, the psychological nature of it completely changes, right?
Yeah,
So
okay.
like when we were talking about like the mistakes that investors make, or I should really clarify, investors versus end users, as you said, is that emotional aspect just on the end users, like say my brothers and those guys, or do investors kind of get trapped into that as well?
They do. And in fact, an investor is probably even more careful when it comes to the margins and the numbers than the end user, because if the end user loves the place, he'll throw the extra 5 or 10,000 into that offer to get it done, right? Versus the investor won't, because they're not as emotionally attached. And you also see a big difference between a first-time buyer, whether it's end user or investor, versus a veteran. There's a huge difference from emotional standpoint, from just knowledge of going through the process and the different questions that I'm faced with kind of every day. But I mean, to elaborate on kind of, you know, this whole investing thing and why everybody is sort of in it right now is, unlike, you know, the early 90s when my parents were telling me when they bought their first home, and rates were 13, 15, 16% or ridiculous rates, is, you know, with how cheap it is to borrow money right now, like the only way to get ahead is to leverage. And, that's another part that we talk about is like, can you stomach and take on the risk of leveraging? Because, it is nerve wracking. There's no doubt about it. You're gonna have multiple mortgages and quite a bit of debt. But again, if the Bank of Canada is going to give me money at 2% and I can't find a way to make more than 2% on that money, there's no point in me taking it.
Well, I couldn't agree more. I found historically as well that a lot of what we're seeing today, at least from my side of things, is really fueled by, frankly, fairly cheap money. So you brought up a really good example that, when your parents bought their house in the 90s, that the rates were really high. So, that's something that anecdotally I can actually add a little bit of value to as well, given that my parents bought my family home when I was a kid in the early 80s. They bought that, I think, at like 18% interest. So it's like, imagine buying a house on a credit card, right? It's a very different paradigm than what we see today. My mortgage is like 1 and change percent. Like, it's basically free. So why wouldn't you lever up if that's the scenario, right? They're basically giving you the money and asking very little back for it. So like you mentioned, your rate of return expectation, as long as you can beat 2 points, then you're in the green, which is fantastic. So the reality is that most people are debt averse by nature for the most part. But what you'll find is that I think that there's a really weird relationship that we have with real estate because of how much leverage you take. Unlike any other investment, for example, in the investment world, at least in the financial markets, max margin that you can take on an investment is typically 50%, right? So you can't actually lever up more than 50 under most circumstances. Futures, you can go higher, but they don't really count. But let's just say for stocks, for the most part, you can't typically go above 50%. But in real estate, you routinely go 80% and up to 95%, right? And of course, you're going to get an outsized dollar or nominal return. But when you look at it in percentage terms, it's actually kind of keeping up with an average rate of return, 7 to 10%, which is what historically we've seen in a lot of the equity markets over time. In fact, depending on what securities you bought, you may have actually outperformed. But what I find that's interesting about what you mentioned is that weird relationship we have with leverage. So given your experience, how have you found people are dealing with the leverage component of buying real estate? Because it is one that you do take on a lot of debt to do it. So how have you found that has worked?
Yeah, for the most part, and again, this will bring up a whole nother conversation we can talk about here, but since the pandemic started, the only market that has really tanked and we're getting absolutely crushed with right now is the rental market. Because the borders are closed, and it will stay this way sure until they reopen, and it may take 6 to 12 months to really recover back to where it was, just with the amount of people that we need to come back into our city and our country, really. With the borders being closed and immigrants really not, coming in right now, and exchange students that were planning to go to all of our universities and colleges throughout, and Airbnb listings that are now on the market for rent like any other listing, and not really just acting as an Airbnb service because all travelers of all kinds are not coming here right now. The rental market is getting crushed, and the investors are not really buying whatever it is, whether it's a condo, house, whatever, because the numbers aren't working like they were in March. So with them not buying these things, the rental market, the cash flow, and talking about, are they willing to take on this leverage? They were always willing to take on, even in Toronto, as long as they could break even, because they figured, what, if I'm even every month and the property's going up 10% a year, buying a $750,000 or $800,000 two-bedroom condo, and I'm making $80,000 and someone's paying my mortgage for me, and it's just a wash every month, they're okay with it. They've even been okay with even being in deficit a couple $100 a month and still being okay with it, because the equity is still outweighing it by quite a bit. But right now, it's quite a gap. Like, we're seeing brand new condos, Yonge and Eglinton, 2-bedroom, 2 bathrooms, $2,600. Like, that's what they're topping out at, which was $3,200 in March.
Right.
So
yeah, I can see that.
Yeah.
And even I found that. So as a landlord as well, I was fortunate that I was able to secure a long-term tenant, in the fall, well before this happened, and they're COVID safe for the most part, which is great. But yeah, that's absolutely a real concern, right? That as an investor, you want to be mindful of that. But one thing, at least that have worked for me, so anecdotally, is as a real estate investor, I always bought for myself and something that I always knew that I would live in. And I bought with what I thought I could comfortably afford without drastically altering my lifestyle in order to do it. So one of the rules I had is I never wanted to be house poor, which so many Canadians end up being, especially in the Toronto and Vancouver area. You pour so much of your net worth into that one nest egg asset that you end up really sacrificing your standard of living as a byproduct of that. So I always was mindful of that. And I was fortunate to buy in the waterfront, basically during the construction era pre-Pan Am Games, right? And after the Pan Am Games, all of a sudden everything kind of exploded, and we fortunately were able to really benefit from the big run-up that happened after that. But that wouldn't have changed my mentality around it. So I guess what I'm trying to grasp from you is, how are you finding, and has there been a little bit of a shift in the investor's mentality on, how much that they're willing to sacrifice their lifestyle in order to become a real estate owner versus just, maybe I'll step back from the market and be just a renter for the time being?
Are you talking since the pandemic or just in general?
I guess in general, over the past couple of years, like as real estate prices have just absolutely skyrocketed in like the last 2 to 3 years, even after the government came in and changed a bunch of the rules. Have you found that there's been more people that are saying, I'm going to step in and still be an owner and a landlord versus, okay, I'm just going to be a tenant and rent?
Yeah, no, people are still doing this for sure. But in fact, what I'm seeing now as well is if people can't buy what they want with how the rental market's changed, they're buying what they can afford to buy as an investment, becoming a landlord, and then renting what they actually want to live in. So that they still have an investment going for themselves. They're still building equity. They're still, choosing what they think maybe is the best investment for their dollar, but it can't quite buy. Maybe they have only $600,000, but they want to be in a 1,200 square foot condo, which we know doesn't exist really in Toronto anymore. So they're renting the 1,200 square foot condo at a cheap rental rate, because that's what's out there right now. And they're still making the investment.
That's the Grant Cardone special. He'll always say, buy and rent out, and then, rent where you live. Right. So that's at least how he started. He's got absolutely tons of real estate now. But you mentioned that the rental market is kind of getting hit, which is interesting because I'm a renter myself. But, what about the other markets? Like my brother's just bought basically townhouse condos, if you will, or like a townhouse, 3-level rooftop, detached homes, even in like the more affluent markets that we have here, in Midtown and that sort of area. Like, are you not seeing anything getting affected there? Like, I just can imagine with, the money not flowing around like it was in the quote unquote, pre-pandemic days.
Right.
Like, how are those not getting affected? Is it because the equilibrium with buyer and sellers have decreased and matched, or what is the reasoning for that?
Yeah, so the two pillars that really will always control price, I believe, is supply and demand and interest rates, right? And we know that money is as cheap as ever right now to borrow. So that's strong. And the demand is still outweighing the supply. We're still low on supply. I mean, could this change when CERB and all these other government subsidies stop? It's possible. But right now, the supply is still low compared to the demand. And what we're actually seeing and working at a brokerage that's owned by a developer is they're securing lots of pieces of land in subdivisions in the 905. And Shiraz, this might be great for you, is that, with this whole pandemic and a lot of businesses now seeing that maybe they don't need the downtown space, or maybe they don't need as much of it, or you don't need to come into work as often. A lot of renters or small condo buyers that were buying in the downtown core just for convenience to be close to work are now going to the 905 and going out to all, Halton and York Region and Peel and everywhere else outside the city, because they're realizing if they don't need to be down there anymore. They've always wanted to have that 4-bedroom house or move from the condo to the semi or whatever the case is, and they just couldn't do it. Now they're able to make a lateral move and sell that condo downtown, and almost for the exact same price, get a semi or something, or even if you go really quite a bit out of the city, to a detached for almost the same price.
That's actually probably what I did, even on myself. So as an investor, I started off in the city on my own primary residence, which was in downtown as a condo. But like most people, we had a family. So as soon as I had my child, my daughter, then we moved into my home that I actually bought almost a decade ago here in Milton. And now we're looking to say, okay, let's get something a little bit closer, kind of a bit. We're a bit too far, in my opinion, from the city. Now, in COVID, it's not so much of an issue, but pre-COVID, I was spending 3 hours a day commuting, which absolutely sucked, and that was not fun. So Finding something that's a little bit closer to the city was more important for me as a priority in my family. So we are looking. But you bring up, again, another really interesting point. That's something that I've at least implemented in my life is I bought what was right for my life at the time. And I always knew in the back of my mind that I wanted to make sure that it was a rentable property, that at least it would have a good rent score, for example, walking distance to certain things or whatnot, and with full rentability. So I bought that on the waterfront. And then when I moved, every property that we have, my one cardinal rule has been just don't sell. So unlike most other investors out there, I'm not liquidating any of my real estate. In fact, it's the opposite. I'm creating a portfolio of real estate, and I have actually, frankly, zero intention of liquidating my real estate. The one thing my wife and I have talked about is that neither of us will ever have a pension. So our savings from our investments and investments, including real estate, will end up helping us in the long run. And as a financial advisor, portfolio manager, one thing that we've seen is that as we're running retirement plans, for example, for clients, anyone that has rental income typically is a little bit better off, especially when they don't have pensionable income. And we're about to see a generation of people that will likely never have pensions unless you're one of the select few that work for government or large entities. So have you seen people saying that we want to hang on to our properties more? Are you still finding there's still this buy and sell and flip mentality?
No, I mean, the only ones that are doing that are, again, I would say if they're buying, a TLC, a gut job, that really they're buying, and within 3 or 4 months it's being flipped. Other than that, they are trying to hold them. There's no doubt about it. Refinancing all over the place, taking the equity out and moving on to something else. Absolutely. I mean, that's what I certainly plan to do as well. I think that especially in some of the areas I bought kind of all over the city, and certain the neighborhoods I bought, I think I wouldn't even think it's a great time to sell. I think that in some of the areas, 5 to 7 years when the whole area is developed, it's going to make a huge change to things. And I'm also a big guy that also likes to purchase, like you just said, walk, score, transit. I think those are huge things. Any big developers that are buying subdivisions or building condos and everything are looking close to GO trains, close to any subways. I mean, everything along Eglinton right now is being scooped up because of the new LRT that's going to be opening soon. So
I live on Eglinton. When the hell is that thing going to be done? Okay,
ask your city councilor, man.
It's been rough. I can only imagine if I was a restaurant or retail shop there. Like it's horrendous for people that work there, right? Some of these buildings you walk by and you don't even know what's behind the scaffolding, right? I can only imagine the issues that it caused for
well, but that's actually when, funny enough, some of the best value can be bought. So what you guys are experiencing right now in Eglinton, that's actually what the waterfront looked like when I bought. So I bought in the middle of that mess, and I was able to scoop up a property, frankly, at lower than market because of that. So if you're opportunistic, you can actually find some diamonds in the rough.
Great for real estate, bad for business though.
Absolutely, right? Horrible for business.
If you're a pizza shop on the corner behind 30 foot of scaffolding, no one knows it exists.
Yeah, it's good.
Let me know how you think about TLRT, right? So, Justin, I want to go back to kind of like the trends. I'm really interested, especially during this COVID time, right? I was posted something on social media the other day, just talking about a study that was done with bank executives. And they said it was a US study, but I'm sure it reigns true in Canada, that like over 60% of them were saying that they're not confident a lot of their employees will come back to 100% capacity anytime soon, if at all. We've seen companies like Twitter saying indefinitely their employees can, work from home. And 40% of those people that did that study said that they are going to significantly reduce their footprint from a real estate perspective. And this goes back to what you were saying as far as people being okay living outside the city. We saw a huge urbanization over the last, definitely 20 years in Toronto, where people moving from suburbs to downtown core to be close to work, to earn that higher salary in the GTA, and then maybe even live outside. But they started moving in, which drove out prices substantially. But now, if these companies like, big business are closing their basically real estate footprint, is this going to drive prices not internally but externally of the cities? Like, are you starting to see that shift? My gut is saying now, living at Richmond Hill and living in Milton where Shiraz is, or living in Vaughan or Ajax, like that's going to become more desirable because shoot, I can just work from home now. I don't have to live at, you know, Spadina and you know, Lakeshore sort of thing, right? Like, are you seeing that trend, or is that yet to actually happen?
Yeah, so it's happening right now for the moment. I mean, a lot of people are thinking the same along the same lines as you. And again, I think that all these property values are going to go up. My parents live in Vaughan, and they're pretty excited about kind of what's going on here because I think at some point soon they'd like to do this move. And the gap between prices in Toronto and anywhere else in the York region and everything was just getting bigger and bigger. And now it's going to be a lot tighter. So they're pretty excited about this. It could certainly go this way. I mean, look, there's still all of the bars, restaurants, infrastructure, sports. There's still everything really in the city. We are expecting, and maybe it'll change with this pandemic or not, but we were expecting over the next 3 years another million immigrants to come to Canada, and majority go to Toronto or Vancouver. So, you know, if you think about that, if you slice it down the middle, you know, 500,000 people coming here over the next 3 years, they're all going to need a home. And so investors, again, you know, once the borders reopen and then rental numbers come back, you know, all the margins will work out better, right? Like, so that's the area. If there's an area right now that is slow, it's the condo resale market. That's slow. The actual market that's only slower than that is the assignment sale condo market. If you guys are familiar with the assignment sales, there are obviously purchases. People made pre-construction 3 or 4 years ago that they're trying to flip and assign their ownership to another buyer just before it's ready. And this is because of a variety of reasons. People have lost their jobs. Now they can't qualify for a mortgage. People just want out because they will not be able to afford maybe the $600 monthly gap that they're going to be short in the rental numbers that they didn't think they were ever going to be. And also, when you buy a pre-construction condo, there are several closing costs that come up. And again, if you've lost your job or you're tight on money right now, you're in trouble. Like right now in the city, you can expect about a $20,000 bill on a 1-bedroom and maybe a $30,000 bill on a 2-bedroom that comes on closing that cannot be mortgaged. It has to be come up with cash. So the numbers there right now are great. I mean, you know, but the freehold market has boomed. It absolutely. And again, this continues to go with supply and demand. If the supply stays as low as it will, this will continue to be. Now, we could be having another chat in November or December or something, and CERB is done and all these other subsidies are gone, and a lot of people are, you know, in trouble. And it's usually the holidays, which typically is always the best time to buy and the worst time to sell, because not as many people are thinking about buying when it's a snowstorm and you really can't see the beautiful landscaping and the garden and the pool and everything else that you may have. So it could be a double whammy to sellers if the supply outweighs the demand at that point. I have 2 listings that are coming in next week that purely are saying we're selling now because we think there's a second wave and we're going to be screwed. And so
you bring up an interesting point, and something that at least I've been thinking about on my end as well is, you know, there's got to be some sort of a ceiling. So what I've noticed is that when you look at what segment of the market, frankly, is moving, right? Historically speaking, anything between, let's say, on the low end, that 300,000 to 400,000 range, to let's say about 800 to $1 million, that little band in the middle is what, let's say, 90% of people can afford. But properties that are above that, which were, you know, the $1 million plus, they've historically always been expensive. And when you look at them, they actually haven't moved that much. So, like, for example, if you look at the Peel area, Mississauga Road properties, their prices haven't really moved that much because they were, you know, $2 million property. They were expensive before, and they're still kind of expensive now. And the people who could afford to buy those are still making roughly the same amount of money, right? So it's interesting when you look at the actual segments of the market that are moving. I find that 500 grand to 800 grand is what moves, and what you can get for that keeps changing. It used to be you could get a detached, then it was a semi, now it's a town, now it's, if you're lucky, maybe a condo.
Right.
Well, sure, that's because the difference, there's a gap that's happening between the home prices and then salaries, right?
Oh, absolutely. I mean, but that's been a long-term trend and frankly, a massive issue. Incomes have not kept up, which this is, I guess, for me as a financial person, the fundamental frustration with real estate, specifically the GTA, is when you look at it from any metric standpoint, typically there's an equilibrium between, you know, income growth to real estate pricing, or, you know, and inflation as well. There's a lot of other variables that go into it. But what you're seeing is that you're not seeing a massive increase in affordability income wise. What we've seen is the opposite. It's actually monetary policy that's fundamentally driving the market. Is that interest rates have gone so low, and lending requirements, frankly, are a little bit lighter now than they were historically. They tightened them up after 2016, 2015, right? But even then, they're still historically easier than, let's say, what my parents had to go through in the 80s when they were qualifying back then. So I'm just trying to get some sort of a sense as to, there's got to be some sort of a cap at some point, like a condo, being, 1.5 million for a one bedroom, like, or are we just completely turning into New York, Tokyo, and London? There's the rhetoric out there that is the globalization and nationalization are Toronto becoming a global city in the same manner that some of these massive places like Tokyo, London, and New York are. Do you see that as a major driver for Toronto as well? Tell me kind of your feedback as to what you've seen.
Yeah, I mean, a lot of people do. Like, I mean, look, in New York, I mean, if you don't get in early, you're usually priced out for life, and you're renting for life. And so many people are doing that. And I've had a few situations like that here, where I had a guy that wanted to spend $550 on a one bedroom downtown Toronto condo. He got very lucky. He was looking with me in October, kept going October, November, December. By February, he was priced out. There was nothing left anymore. Nothing was ever coming up under $550 for a one bedroom condo in kind of really the entertainment district in the core that he sort of wanted, because he wanted at least 600 square feet. Under $1,000 a square foot is really, really tough to find. And then the pandemic hit, and he bought the first week of April and got very lucky, because already now in July, already he can't buy again. So he got very lucky that he pounced when he did, and he got in, because a lot of people in that time, when there was no eggs left in the grocery stores and no toilet paper everywhere, there was panic, and yet he still pulled the trigger. So I got to give him a lot of props there, because that takes some guts to do. But that's where he did. That's what's happening. A lot of people now, are saying, I'll rent for another year. I'll try to save another 15 or 20,000 to buy. And the problem is, if these prices go up another 10%, you're renting for another year, so you're paying 2,000 or whatever a month times a year. So that's $27,000 that you're spending there on rent, and the market goes up 10% on these $550,000 condos. It's up 55,000. You're trying to save 15 or 20. How are you saving?
Well, like, we're talking about affordability, guys, and I remember, Justin, correct me if I'm wrong here, but last year I read another study, and it was talking about affordability in Vancouver and Toronto. And what they did is they looked at the average salaries of a couple in both of these cities. And they said, if you make average salaries in Canada, which I don't know what it would be now, mid 50s, right? Times one or two people. Okay.
Yeah.
What percentage of the properties in these cities can you not afford? And in Vancouver, it was like 94%. And in Toronto, it was like 87%. So just for everyone watching, like, that's, if you make average income in Vancouver, you cannot afford 9 out of 10 homes. Like, my question is, and you're a real estate agent, so you'll have a great pulse on this, but over the course of your career, like, who are buying these? Is it just that 5% of residents, or are you starting to see more and more people outside of town or outside of the country come in and buy? Obviously, there's an international component to this, but like, how much or how little?
So for first-time home buyers, it's a lot of help. Almost everybody is, whether it's help with the down payment or a parent co-signing on the mortgage, because that's even been a challenge a lot for these people too. Is with $50,000 salaries, you can't get like, they may think that they could pay the monthly mortgage, but the banks won't qualify them. So they're getting co-signers for the mortgage. The parents are maybe helping with the co-sign and some of the down payments. And look, I mean, people are putting at the most 20% down on these properties. So they have huge mortgages. There's a lot of leverage here going on. They're obviously, pretty thin, but they're starting out, and they're realizing that, and a lot of people now are not able to buy their dream home that they wanted to buy. They sort of need to climb up the ladder, and they wanted the detached. Well, they're going to start in the condo, and they're going to build equity for 2 or 3 years, and they're going to flip that. And now they're going to maybe even crack into a town or a semi, and it's going to take time to get that 4-bedroom detached house these days. And that's just kind of the reality of things and kind of what we're seeing here.
Absolutely. I
So
mean, even in my own experience, I mean, that's almost exactly what we went through. And, as a household, we make well above average income, right? Between my wife and I. And, I'm always mindful of who is affording to buy these things because we make significantly more money than a lot of other people out there. Yet, I guess one of our fundamental things is that, Grant and I have talked about this in the past as well, is I'm also unwilling to liquidate my real estate to buy, right? So
Right.
I'm actually, from a conservative standpoint, really taking it to the nth degree. I imagine that all of my properties end up being vacant and I have to cover the carry cost of everything with no rental income, which is frankly not likely to happen. But from a financial planning standpoint, I just assume I got 3 mortgages that I have to pay for and have my property sitting empty for 3 or 4 months at a time, right? Can you still afford to do that is the question, both by buffer of savings and also just really net income to your home. And that's how I base my decision making. Now that's really down the pipeline on how people would actually look at it. Theoretically, I could probably buy a much bigger property, but I'm actually willing to settle for something that's a lot smaller than what, frankly, my income and what the bank and all these lenders would want me to buy. They want me
Right.
to lever up way more than I'm frankly willing to. So how are you finding that people are actually dealing with this? Like, are they realistically just becoming really house poor in order to do this?
Yeah. I mean, that's the biggest thing there. And our threshold, we look at it as you shouldn't be spending more than 1/3 of your monthly income pre-tax. That's the max you should be spending. So if you're
how
making,
many people are abiding by that though, especially in
they're not,
Toronto?
and
Yeah.
that's where they're becoming house poor. Exactly what Traz is saying, right? Because, I mean, if you take, a $60,000 salary, so that's $5,000 a month. So a third of that is what are we talking here? A third of that is just under 1,700. Well, you can't buy a 1-bedroom condo downtown with 20% down, with the mortgage, maintenance, and property taxes, and your hydro and your cable, internet, you name it. You're not getting it. It's just not happening. So, look, I mean, it does work if you're a couple and you're doing it together. It works. But yeah, it's certainly challenging. And I think also, and Traz, you may be able to speak to this more as well, as I think a lot of people in this generation are staying at home and staying with their parents as long as they can. And it's probably a lot longer than maybe you did, and definitely longer than my parents' generation did. My parents were married at 23. I didn't even move out of the house until I was 24. And I know some people that are still living with their parents at 28. Right. So
Right.
the savings are, again, I don't know, again, how much exactly they're making, but to be able to have rent free for a few more years. I never wanted to rent. I was just never wanted, just because of, I just didn't want to pay someone else's mortgage for them. I felt like it's not going towards anything that benefits me. So if I had the choice to stay home, and I stayed home as long as I could till 24, till I could buy my first place. And then it went on from there.
Interesting. So yeah, no, I can speak to that, at least from my end and what my experience and what we've seen, at least as a practice as well. People are absolutely staying home longer. I mean, bank of mom and dad, frankly, is what you kind of mentioned earlier. That's really what's financing the market, especially for the first-time buyers from our side as well. But it's interesting because that becomes a liability on the parents as well. And unless they've saved pretty significantly, they might not even be necessarily in a position to be able to afford that either. So it's kind of an interesting dynamic when you think about it. But what was also kind of unique to look at is people are actually also personally really leveraged, right? Is that Instagram lifestyle, frankly, has really caught up to a lot of investors because they're in a position where, okay, well, I want that nice car, I want that Beamer, or I want that Porsche, and I also want that property, and I'm willing to spend, and I need to have that Gucci bag or whatever the case may
Yeah.
be. It's that millennial generation thing, and I don't mean to be pointing the finger, but there's a lot of that, like I want it today, that instant gratification, and unwilling to wait to get it. So, yes, they may be staying home longer, but are they making the most of that time is always my biggest question to them is, are they going out there and, frankly, levering up and buying and living that sort of consumption lifestyle? I actually feel that COVID has done one positive thing. I guess a silver lining to that is, for a while you couldn't even spend money if you wanted to because everything was closed unless you were
Right.
able to, get one of the few people to get essential services delivered to you from Amazon, which frankly, that was not an easy thing to do for a period in March. But if you're not, it was hard to spend money and you couldn't go out and, eat out and whatnot. So everybody kind of sort of reset and recalibrated at least their own internal spending schemes, frankly. And I think it kind of rejuvenated sort of what I would say my parents' generation's mentality on, okay, eat at home, save money, be
Yeah.
conservative. So I actually think that that might have been a little bit of a silver lining on people. And time will kind of tell to see, okay, well, does this generation just kind of shrug it off? But there's an interesting stat in a chart that I was looking at recently that Gen Z, who's kind of going through this pandemic right now in their 20s, they're going through a really impressionable time right now, and this is frankly the worst scenario that's ever happened since the Great Depression, and they're kind of living through it. And when you look at the greatest generation, those who actually lived through the Great Depression, what their mentality and predominant sort of mental state was from an investment standpoint, and the risk tolerance was historically a lot lower than Gen Z and then millennials. So the question will be, is that will a Gen Z become more like a boomer or a great generation? Or are they going to be sort of somewhere in between? Are they going to be a whole different scenario altogether? It's going to be really interesting to see how that kind of pans out.
I think like Shiraz, on that point, you brought up so many good points. And when I was at the firm I was with before I joined Raymond James, one of the portfolio managers at that company, her name's Christine Tan, and she's Southeast Asian as well. And she basically got into the industry during the Asian crisis. And she always told me, Grant, it's really funny when you look at any investor, their first 5 years of making investments, whether it's real estate or in the market, it doesn't matter. Those first 5 years almost shape how they view the rest of their investing days. If you got into the investing game in 2009, 2010, well, you've been hitting home runs for the last decade, right? But if you started investing in 1999 or 2006 or pre, any crisis or pre-COVID in the case we're living now, it totally changes the psychology of how you view risk, how you want to take risk. Like, we're seeing people, as Shiraz mentioned, like revert back to the old ways of saving money, cooking at home, realizing I don't need to splurge on all those things. Don't get me wrong, going out for a drink on a rooftop patio is nice, but you don't need to do that 5 days a week, right? Once a week, once every 2 weeks, go to the movies. I'm starting to see a lot of the habits of my grandmother's generation come back, actually, not by choice, but being forced, which I think is good. So if you're a young 20-year-old getting into the market now, you're going to be conditioned by what we're going through right now, right? My generation, we've known nothing but success, right? I'm 32 now. When I was in my young 20s was basically right out of the financial crisis. So as I got out of university, I just rode this amazing wave, right? So it's going to be really interesting to see how people adapt moving forward. But what I want to do is, before we wrap up here, Justin, I want to get your top 3 real estate city picks. If I'm an investor now, not an end user, I'm not buying my dream home for my wife and kids.
Right.
If I'm looking to make some money, I want to preference that, right? If I want to make some money here, and you're going to give me 3 cities or 3 areas or 3 streets, in the GTA or, Southern Ontario area, where are you buying?
So, okay. So firstly, back to what Shiraz was saying before, I'm buying in that price range that we spoke about before. I'm not buying a $3 million house, and I'm not buying the lowest of the lows either. I'm buying something in that $500,000 to $900,000 range. I love personally, if you can still buy, and I'm seeing a lot of people do it now in southwestern Etobicoke. If you could buy a nice 50-foot lot in that area, a lot of them have bungalows on it, whatever, and you can rent it out, a livable bungalow, and you can rent it out. I think that, give it 3 to 5 years, build a beautiful house in there. That's a lot of where a lot of people are looking right now, because that area is still cheap and it's very close to the city and it's great real estate. Another area, again, and it's already starting to really go a lot, but anywhere west of Bathurst along Eglinton, all of the Oakwood, Humewood community, if you're familiar with this area, all the way across to where the stockyards are, almost an old Western road. But a lot of, you can see all the developer, and you can follow this with just looking online and seeing where all of the new sites and developments are being chosen, because the developers obviously aren't stupid and know where they're obviously locating where their next project's going to be as well. But that's where there's a ton of houses in this area. There's quite a few of them under $1 million, and you're going to be right on transit. You're no more than, from Eglinton, you're no more than a 20-minute subway right to Union. These are areas that you could still buy right now. They're old homes, but they have so much potential. Whether you're renting them out, whether you're going to add a second story onto a bungalow, or if it's already a 2-story, you're going to add an extension on the back of the house, or you're going to renovate. There's a lot of upside and a lot of potential. And if you go one area just east of there is the Humewood Cedarville area. There are so many homes that you can look back on that were purchased in 2015 in the 8s that are now selling for the 1.3, 1.4 margin. So quite a bit in just a few years.
Man, tons of gems. I appreciate it. We got the 3 best areas in the city now from my man Justin. So if you're looking to buy, we're going to include all his information in the post, whether it's above or below, depending on the platform. We'll make sure, Justin, to get all your information out. So, all your Instagram, your Twitters and all that stuff, so people can find you if they have any further questions. Appreciate you taking the time, man, honestly.
Oh, guys, this was such a pleasure. We could do it again for sure. Always love talking with you guys. And Grant, you've been always a mentor. So for sure, we'll talk.